Am I fool number one, or am I fool number two? How many other guys have been fooled by you? I suppose that the number is far from being small, and I'll bet that I'm the biggest fool of all. Ah. Hello, David. Can you hear me, David? You are connecting. Okay. Hi, David.
Hey.
Can you hear me?
Yeah, I can hear you.
Okay. Hi, Joanna. Can Joanna hear me?
Yes, I can hear you.
All right. I can hear you too. So far, so good. Give it another couple of minutes here. Have you guys, are you among the students who attempted to finish problem P37?
No.
Where we have a problem with the publisher?
Yeah, I did it last night.
Yeah, yeah. Did you get my email on that explaining that it was a problem with the publisher?
Yeah.
Yeah, that it was saying that it was not working, but it is right. Yeah.
Yeah, we've had a pretty good relationship, I think, with McGraw Hill. I like them a lot. But one of their more recent versions wasn't proofread maybe as good as it could have been. And we're running into this not frequently, but if you see it even once or twice a semester, it's too much, you know? I feel bad for those of you who spent time putting that number in over and over again, knowing it was the right number here. Let's see. Hold on, what time we got here? Yeah, it's what, 11? We got a few more minutes. Hey, Dave, what position do you play on the football team anyway? A running back?
Slot receiver.
Slot receiver. All right. You like Wes Welker and
Edelman.
well, yeah, Julian Edelman, the famous slot receivers. Are you one of the girls from Sweden, Joanna?
Yeah, I am.
You like American football?
I know nothing about American football.
Like we know nothing about soccer in this country.
We know a little bit, I guess.
Hi, Kalai. How you doing?
Good.
You don't want to show your mug again, right?
I don't have camera. I have a desktop, not a laptop.
Oh, really?
Yeah.
Okay.
Yeah.
But then that begs the question: how do I know that's really you, Kalai?
I don't know. I'll tell my Sports Center story to you one day, maybe, and then.
Oh yes. You decide. You decide when that's appropriate. You want to tell it in front of everybody? That's okay.
No. I don't. I'll tell it to you guys. That's perfect. Only a couple people. Anyway, it was my senior high school? Yeah, senior high school basketball season, not even football. And I made like a 3/4 court shot on this playing against this other team, and I ended up number 10 on the
Really?
top 10. Yeah.
Oh, that's pretty cool on Sports Center, huh?
Yeah.
That's got to be a real thrill to be in the Sports Center's top 10.
I don't know. I was never one of the I don't know, achievement guys. I just played.
Yeah, I'll be proud of it. Hi, Callie. Can you hear me?
Yeah.
Hi, George. How you doing?
Good.
Do you want to show your face, George?
Yeah.
Okay, we got Danielle. There's Danielle. We're getting a pretty good crowd here, huh? Hi, George. Okay. All right. Chapter 3 is a real key one, huh? Now you're introduced to journal entries like crazy, right? Anybody have trouble understanding what a journal entry is all about? What does a journal entry do? What's the purpose of a journal entry? Anybody? I'll take that question. When you post a journal entry, you are updating the general ledger. You are making a permanent record into your general ledger. You are increasing an account. You might be increasing another account, depends on how the debits or credits are going, okay? And in this course, that's the only way we put things into the general ledger. You hear me, right, Danielle? I forget if I checked with you. All right. I get the thumbs up, all right. As long as I don't get the other finger, right? That's Fiona. Okay, we'll let Fiona go in. Then we'll get going with the PowerPoints. Hi, Fiona.
Hi.
Okay, here we go. What I thought we would do is, let me put this here. Give me a second here to get this thing set up correctly. All right, here we go. Share screen. I said share the screen, darn it. Oh, Jesus, here we go. Share. Here's my PowerPoint. I go back to the meeting. Share screen. Where's my PowerPoint? What happened to this thing? I have a PowerPoint sitting right in front of me. I'm looking at it. You cannot see it yet, right? No, you can't. I now want to share it. I go into our meeting, share screen, and it's not there. For heaven's sake. Do you see anything now? Do you see the PowerPoint?
Yeah, we
You
see it.
do? Amazing. I don't know what happened. All right, here we go. And come on out, get home. Okay, chapter 3, we talk a lot about the use of journal entries and how they get into the general ledger, which is really a glorified T account, okay? They talk about the operating cycle. I guess you can say it begins when we open up our business and we buy things and sell things and we pay. And we keep doing that and we receive cash. Operating cycle, that's kind of a unimportant slide, I think. Here we go now. Here we get into some of the accounting principles, if you will. And our test bank loves to pop a few of these onto the tests, okay? The operating cycle, the time period is the accounting principle that a business can be broken up into finite time periods in order to measure its progress. Often a month, I would say almost always a company does this once a month, they close. Time period, company's business can be busted up into a specific time frame. Here's an important one, recognition, the recognition principle. When are operating activities recognized? They are recognized when they're incurred, and we'll get to that. And measurement issues, what amount should be recognized? Is the number right, huh? What's on the balance sheet? We should know by now that the balance sheet in its simplest terms is sales less expenses. And that's what they're saying here, revenues. And these definitions, like I say, are jargon. We know what revenues are, they're sales. Less expenses gives you what's called operating income. Operating income. After operating income comes things called other income or other expenses, And they can be in the form of gains or something that has nothing to do with running the business. The one gain you might have is interest income. You might be a manufacturer, but you have a lot of money on hand, which you loaned out to somebody, and they're paying you interest. That interest income has nothing to do with the operation of the business, so it goes below operating profit. Interest expense is an example of a loss. They're not called expenses, they're called gains and losses. And here is a look at the consolidated income statement. And note what I'm talking about. Sales minus all of these restaurant business related activities gives you income from operation. That's what Chipotle earned from their operation. They made 356, that's a big number, huh? $356 million from selling Mexican food. Their income from operations, 356,400,000. But they had other things too. They had some investment income, they had interest expense, and they disposed of a fixed asset. And then you come to your income taxes. So you got operating income, huh? You got earnings before income taxes, net income after. Operating expense, this is any expense that's related to the core business, right? It's an expense if you buy something, perhaps you pay off somebody. An expenditure. Expenses are outflows of using. There we go with the jargon again. And expense is rent expense. It's salaries and wages. It's depreciation. And they're just showing you expenses typical to Chipotle's, food, beverage, and packaging. That's got to be their biggest one. Occupancy, other. Now, here, this is important now. In our class, we are not teaching the cash basis at all. Cash basis is not GAAP. No business that wants to be able to borrow money would use a cash basis. And if you use a cash basis of business accounting, you'll put yourself out of business before you know it. It's not proper, it's not useful. Everything we're doing is on the accrual basis. Accrual accounting. Accrual accounting. It means that assets, liabilities, revenues are recognized when they're incurred. It usually has nothing to do with when the cash is paid or received. For example, you sold to a customer $1 million worth of merchandise. The revenue then is going to be recorded as soon as you made that sale. As soon as that truck left your factory, that is a sale. The fact that they're going to pay you in 2 months is irrelevant. You recognize the revenue when the sale is made. You recognize an expense when it's incurred or when it's experienced. During the month, you know you had electricity to run your business, but you don't have the electric bill yet, but you have to record something. Accrual basis is GAAP, generally accepted accounting principles, and without it, you can't borrow money from a bank, you can't attract investors, you can't demonstrate to the world that you know what you're doing. Revenue realization principle, huh? Now, I guess we're with Chipotle's. Revenue realization principle, huh? The cash could come before you deliver the food. It can come after you deliver the food, or it could come at the moment you do make the delivery. It all is based on when you did the act. Here is where you record your revenue, when the food was delivered. So let's take a look at it here in real simple form. Here, cash is received on the date the revenue is earned. So this is pretty easy. We work for Chipotle's and we delivered some tacos to a business and they paid us right away. We debit cash and we credit sales or revenue. That's pretty easy. But what if they pay us before we deliver any food? That brings us to something fairly new to you guys, unearned revenue. Unearned revenue. Monies received in advance for services that are not yet performed is called unearned revenue. We're going to debit cash and we're going to credit unearned revenue, which interestingly enough is a liability account, okay? We got a check from City College, Chipotle got a check from City College to cater a big meeting on campus. Big meeting. $2,000 we mailed in, but the meeting's not for another month. That credit to unearned revenue is a liability. We don't owe money to Santa Barbara City College. We owe food. When the food is finally delivered, we're going to reduce that liability called unearned revenue, and now we're going to increase a revenue account. Unearned revenue. You'll be doing that journal entry in chapter 4. And again, the revenue principle. We might get the money later. We delivered this food to City College and we handed them a bill that they're going to pay in 30 days. That's revenue. It's revenue because we delivered the food. The fact that they're not paying us for 30, 60 days is irrelevant, okay? That's what accrual accounting is all about. You record revenues at the time you receive, at the time you perform the service. Then when we get paid, we get paid. Debit cash, credit accounts receivable. This has nothing to do with revenue. It's just an exchange of assets, right? Same thing with the expense matching principle. The matching principle, that's a real key principle of accounting. Matching, we're matching revenues and expenses. That's all it means. Revenues and expenses, matching. We are going to record expenses on the day we consumed the service or the expense. And it doesn't matter if we paid in advance or we paid afterwards. So let's see what we're talking about. Here's an expense. We called in a repairman to do some work at our school. The guy had to fix the copy machine. The guy came in, he or she, and they did the job, and we handed them cash. We debit copier repairs expense or repairs expense or something. We credit cash. Cash and expense, in this case, go together. But if it's paid before, if we pay a bill in advance, that is a prepaid expense. In other words, if we called up the copy guy and he said he's not coming till we give him a check and he won't come for another couple of weeks, that's a prepaid expense. Insurance policy, that's an asset. We credit cash. And now if you look at the next slide, that asset, here's the original entry, that asset called a prepaid expense is an asset, is now being reduced because the person did the work. We bought an insurance policy here, paid cash, and then the next year, as we experience the benefit of the insurance, we use up that prepaid asset. And here, the cash is paid afterwards. The guy came in, he fixed our copier, and he handed us a bill. The expense is still recorded when incurred. The payment is later. Make the payment later, we reduce cash with a credit, we debit or reduce the liability, huh? Let me just do something here real. Oh, that's better. Now I can see it. Okay. Let me just drag this out of the way here. Okay. Here's a look at the debit and credit world here. Are we getting good with the debits and credits? Later on, when we have a drill, can everybody immediately tell me what's a debit, what's a credit, what account? Assets, debit balance. Expenses, debit balance. Assets and expenses, debit balance. Maybe you just have to memorize those two, because then everything else would be a credit, such as all of your capital accounts and your revenue accounts and your liabilities. Let's see how they affect retained earnings. Oh, this is getting exciting. Let me get to, hold on. Okay, here is retained earnings. Retained earnings is a capital account, and retained earnings represents all of the income and losses that this company has experienced since day one. When they began this business on January 1st, 1910, they had no retained earnings. And now here we are, 100 years, 110 years later, and their retained earnings balance is, say, $1 million. That means that they made an income total over those 110 years of $1 million, assuming they didn't pay some dividends, okay? Retained earnings. Revenue increases. Revenues go up with a credit. Expenses go up with a debit. The difference between the two is hopefully a profit that's going to roll up into retained earnings. Your profit's going to end up going into retained earnings, okay? Now they're getting into some transactions here, and it's skipping ahead to G, but let me just see here. Okay. They skipped 5 transactions, I guess, for a reason, but let's look at this, okay? Chipotle bought food and packaging supplies costing $2,077. They paid so much in cash. The balance would go to accounts payable. So let's take a look at this. We debit supplies. Really should be called prepaid supplies, by the way. I don't know why this book doesn't use prepaid supplies. Prepaid supplies, we debit. We credit cash for the amount we had to pay up front, and the balance goes to accounts payable. So here they're just showing you that you have your accounting equation in check here, in balance, huh? The supplies, that minus that, equals that plus the, equals that plus over here. Hold on. I just want to take a look at this real quick. So we're in balance. We owe 40,000. Assets minus that equal that. And now the effect on the general ledger. These two accounts are your general ledger. We had a cash balance of 349, and it's now been reduced to, it's been reduced by 167,000. We have more supplies. Payables went up, huh? Wow. Let's take a look at another one here. Now, here we go. We're paying in advance for 6 months of something, and we're paying for insurance for all of 2012, and we're paying advertising. These are all prepaid expenses. These are all prepaid expenses because we're going to get the benefit in the next 6 months, not the month where we had to pay for it. Prepaid expenses are assets. So here what they did, they added up the 36 and the 32, and they got 68, and 18 is 86. Most companies would not just call it prepaid expense. You would have 3 separate accounts: prepaid advertising, prepaid rent, prepaid insurance. That's okay. And again, they're showing you that the equation remains in balance. We exchanged one asset for another. We gave up cash for these prepaid assets. And there's the impact on the financial statements. There's our beginning balance of 349. There's transaction G. And now we're doing H. We sold food for customers for $619,000. 4,000 was sold to universities on account. Whenever you hear the words on account, you understand that means on account and nobody had money. And I say that jokingly and seriously. When you see the words on account, you know there's no money in the transaction, that part of the transaction. On account means it's either going to be accounts payable or accounts receivable. So let's look at our journal entry. The total revenue was $619. They delivered the food. Telling you right here, they sold it. The revenue is recorded at the point of the sale. The cash was that amount. Accounts receivable. Again, we're in balance here. Equity 619 equals that total. And look at our T accounts. Now we have revenue here, and we have another receivable. Cash went down. Training expenses, huh? Training. They don't talk about the timing. They're just saying that we had training expenses. You debit that expense and you credit cash. Not too tough, I hope, as I go through these. Hopefully these slides get a little more interesting in a couple of moments as we work our way toward the finale. Chipotle paid employees who worked this quarter for $138,600 and last quarter for $91,500. Now here's a tricky one, huh? They wrote out a check today. That check was for $138,600 plus $91,500, which is what, $229,100 or something. But look at the components, and let's talk about this. They paid this amount, $138,600, to people who worked this month. That's an expense. These people worked this quarter. The people working this month earn this amount of money. That's the expense so far this month. The $91,500 from the last quarter is not an expense this quarter. It is an expense we accrued last month. Last month, we wrote an adjusting journal entry where we debited salaries expense and we credited a payable called accrued salaries payable. Okay? This $91,500 represents the last couple of weeks of the prior quarter, where people earned that amount of money, but they did not get paid until this journal entry. And again, we're keeping the equation in balance and posting to the general ledger, our general ledger. And here we sold some property and equipment, and it looks like we sold it at a loss, huh? Do we have to do some arithmetic? We sold for cash that cost us $11,900, and we sold it at a loss. So take a look at this. We sold it for $10,600. The property and equipment on our financial statements, on our balance sheet, was historical cost of $11,900. We were only able to get rid of it for $10,600, and we suffered a loss. That type of loss is a gain and not part of operating profit for now. Okay. The rule is actually changed on the gain loss on our property equipment, but we don't go into that until chapter 7. Here we go. Customers are paying us. No revenue involved here. We recorded the revenue when we delivered the food. So now we're just getting paid, a swap of assets. And we paid suppliers, huh? We paid them. We had used the product already, and now we're just making the payment to the supplier. Chipotle incurred and paid $10,000 for facilities, huh? And $48,600 for maintenance of its facilities. And they're calling the $10,000 an expense called occupancy expense. $10,000, that should probably be called utilities expense, huh? That would be clearer. And maintenance expense is hardly in other. That should be maintenance expense, but that's okay. And again, we're keeping the equation balanced, and we're carefully posting, using these letter keys here to keep things straight. Very important. Hey, Chipotle had money lying around, and they put it into a savings account, and they earned some interest. Debit cash, the asset, credit investment income. Now that's a classic example of non-operating income. That would be added to your operating income to get to the net income. Chipotle is not a bank. They're not supposed to make money by investing. It's good they have the money to do so, but it has nothing to do with making tacos. And gift cards. And I don't know if you were assigned that article about gift cards. I always find this interesting. Chipotle sold gift cards to customers for cash. This is classic unearned revenue. They sold, let's say it was $100 each. They sold 154 $100 gift certificates to people. At the moment of the sale, there is no income. There's no income because nobody has yet used the credit cards or the gift certificate or the gift card. It's only when the customer comes into the store and they buy something for 150 bucks and they hand you $50 plus the gift card. Now that becomes revenue, and we would debit this unearned revenue account, which is a liability, and credit regular revenues. Do companies like it? Do companies like it, you think, if customers don't use their gift cards? I mean, they're getting that money for free. Do you think they'd be happy with that? Anybody want to make an opinion on that? Nobody wants to touch that one, huh? The point I'm making is this: the company definitely wants you to use the gift card, because 99% of the people who use a gift card for $100, whatever it is, will end up buying more. So if businesses are making money simply by giving away gift cards and nobody's using them, it might indicate that their product is so bad nobody wants to cash in their gift cards. Here we go. Look at this beautiful thing, huh? Here is your general ledger. You have a beginning balance, and you have the various debits, huh? That was that big sale there of food, and there's that 4,700 income. We had no activity with short-term, and here we go. These are our balances now. Okay, what are we going to do with these balances? Here they're just showing you the balance sheet items. Here is the income statement parameter, huh? Sales, and then we have this other income. So these two numbers add together, and from this we'll subtract to get our net income. The question becomes, what do we do with these ending balances from the general ledger? The month is ended, and here's what we're going to do with them. We're going to prepare the trial balance. Notice it says unadjusted trial balance, unadjusted. Preliminary is the word that you pretty much see when you're in the workforce. I've never seen the word unadjusted, but that's what it is. Preliminary trial balance. We're just posting all of these balances. Let's just do a few quick ones. Cash was 370. Short-term investments was 113,700. Cash, short-term, I said one, I misread that, I suppose. Let's see. Cash. Oh, I'm sorry. Yeah, short-term investors 90. I'm sorry, my eyes slipped there. That's all we're doing. That's all we're doing at this point. We're going to take all of the balances that are in your general ledger. We're going to list them in the proper order, starting with assets, liabilities, equity, revenues and expenses. It goes in that order. The only thing the trial balance does for us is provide assurance that that our debits equal credits. And like I've said before, you will probably never run into that problem because there's no computer system worth its salt that will allow you to enter an unbalanced journal entry. Believe me, from the old days, you can do that when you're working with pencil, believe me, okay? So the trial balance is not a financial statement. It's nothing that we want to show to the public, nor would the public want to see this thing. It's just a piece of scrap paper to get us going on our journey to create the financial statements and complete the accounting cycle, huh? How are financial statements prepared and analyzed? Income statement, revenues minus expenses. We kind of know that. Statement of equity. We've been over this a bunch of times. Let's do it again. Statement of equity. It'll be your beginning equity. They're just limiting it to retained earnings for purposes of learning. But your beginning equity number plus your net income minus dividends gives you your ending retained earnings. And the balance sheet, assets equals liability plus stockholders' equity. And that stockholders' equity can have a contributed capital portion where you, the owner of the business, put your own money in it, or you issued stock to the public to raise money. And retained earnings, the only thing that impacts retained earnings is your net income or loss and dividends. And then the statement of cash flows, which we're not going to worry about here. And here they're using the arrows. This is actually a pretty good template to have in front of you when you're trying to get this. We have to do the income statement first because it fills in this line on the equity. And when we get the ending equity, we bring it down here. Okay. The templates. I always talk about templates, meaning a picture. Revenues minus expenses, template, beginning equity plus net income minus dividends. And the statement of cash flow should add up to the beginning cash minus the ending cash. So here we go. Here is their income statement. Where did they get these numbers? Anybody want to yell out where they got these numbers? What report did we just look at? Somebody just say trial balance, will you? Got it from the trial balance up here. And I'm going to give you another tip. In this course, I don't think we ever provide you with a trial balance that is out of sequence. So I'm going to show you a little tip here. You see your sales line here, everybody? Put a little horizontal dash right there, a horizontal dash. The reason for that is everything below that horizontal line is your income statement. Everything above is your balance sheet. It's easy to get a little rattled on a test, but take a deep breath and you say to yourself, oh, gee, yeah, after the first sales account begins the income statement. So those are your sales, 619 plus the 47, and then they're laying out all the expenses. So the income from operation was this 372. The investment income is considered a gain and not part of operating. And the loss, they got a misspelling here. The gain or loss on the disposal of a fixed asset was 1,300. Actually, gains and losses on fixed assets are now part of operating, but that's a recent change, okay? The following classified is meant to highlight the structure, but because it's based on unadjusted balances, it would not be presented to external users. What they mean by that is that preliminary trial balance could be 100% wrong. Every single number could be absolutely wrong. That's why you have to go through an adjusting process. So this financial statement here is going to change based on some adjustments that need to be done. And I can't wait to get into that chapter, huh? One of the metrics involved, you take your profit and you divide it by the sales, and you are going to get a percentage. And that is what the net income percentage is. So Chipotle, when you divide it out and turn it into a percentage, Chipotle earned net income of 9.47%. Another way to say that, everybody, is Chipotle earned I didn't want to say that. Chipotle earned 9 cents, almost 10 cents for every dollar they sold. And you have to make a judgment. Is that a good return on a company's business? I would have to think it is these days. I don't know. Some businesses expect more. Some are content with 2%, 1%, but they're doing a lot of turnover and still making money. Okay. So that's a quick look at that chapter. Can I open this up to any questions you may have or anything else you want me to take a look at? Is there something confusing? We're not up to, let me ask this question. They are talking about the preliminary trial balance. Would you want me to go into start on chapter 4 now and get into adjusting entries? Would you prefer to study this and come back on that Thursday?
Come back on Thursday.
Okay. All right. We have a comeback on Thursday then. Okay. Hold on here. Okay. Yes. Question?
More like a comment about this chapter. It's been a little tricky for me. I think I keep getting confused by the process of like doing a balance sheet and then doing the income statement. I'm getting like a little overwhelmed with
In preparing the
stuff on-
finance. Okay. Overwhelmed in preparing the statements, you mean?
Yeah, just like the information from one keeps getting me like confused with on the other. I don't know.
Okay, you're not the only one, believe me. First of all, let's understand the sequence. We know we have to do the income statement first, and then the equity statement, and then finally we can do the balance sheet.
Okay. I thought the balance sheet went before the income statement.
No, and let me show you why. Let me find that. Let me see where that was. By the way, if you look at this video after I load it up, skip the first 2 minutes because I was fooling around with the guitar, making some horrible noises. Oh, for heaven's sake, I know it's here. Must have been way at the end, huh? Hello, back at the beginning. Okay, here we go. We'll get it this way. Here we go back to the end. Come on. Done. Control end. I do want to show this to you, Danielle. I want to show it to everybody. Come on. Da, da, da. I guess it was that one toward the very end. I didn't think that's what I wanted, though. Okay, we'll go through the transactions. We'll get to the general ledger. Boom, boom, boom. Okay, the balances. Okay. Wasn't there a grid on, oh, here we go. I'm so sorry, I stumbled along here. Here we go, everybody. Danielle, look. The income statement is your sales minus your expenses, okay?
Yeah.
It's as simple as that. You go up to your trial balance and you draw that horizontal line above your first sales number, and everything below that is the income statement. Why do we do the income statement first? Because we need to get the income in order to figure out the change in retained earnings. And you see these 4 lines here? This is a template. If you get a problem on a test and it says prepare the equity statement, don't even look at the numbers at first. Don't look at the numbers. Write your template down. Beginning retained earnings from last month, plus the net income, which you computed here, right, Danielle?
Mm.
Minus any dividends gives you the new number. Make a little bit of sense?
Mhm.
The income is what updates the retained earnings. Therefore, we have to do the net income first because we can't figure out the retained earnings. Now that you know the retained earnings, you can then put it into the balance sheet in the equity section of retained earnings. And again, we'll be learning this process in some detail in Thursday when we get into chapter 4.
So what is like the relationship between the items on the income statement and the items on the balance sheet?
The income statement, whatever the income statement yields in terms of net income, then will roll into the balance sheet as an increase in retained earnings. Your
Okay.
net income is going to end up going into retained earnings on the balance sheet, but
Okay.
not until the end of the month when you prepare the financial statements.
Okay.
Okay? Anybody else have a little problem with the putting the statements together? Hey, Fiona, you came in a little bit later. Did you get stuck on that problem 3.7 where they had the wrong number in the book?
I haven't done the chapter problems yet.
Okay, well, look at the note that I sent out. 3 or 4 of the students contacted me and they said, hey, Bob, as far as I know, this is the correct number. And when I enter it into this Excel spreadsheet, it's telling me it's wrong. And then I looked at the number and it was right. And then I figured I was doing something wrong. And I looked at it and I realized it's another one of these clunkers. Any questions, Callie? You usually have a good question or two, no? Put the pressure on Callie.
Can you can I ask you the quiz?
What's that?
Can I ask a chapter 3 quiz?
Oh, yeah. You have a question on the quiz?
Yeah.
Okay. Do you have it in front of you right now? I can, why don't you read it? Let's try that.
Yeah, can you show me the income statement?
Sure. Income statement, okay. The income statement comes right from the trial balance. Income statement's going to be everything starting with your revenue. And here is your income statement. You want to take a look at this?
I mean the chapter 3 quiz. I want to submit, but it always said I haven't completed. So I don't know why.
Ah, okay. Let's I'm not sure I can help you with that over over the airwaves here. Did you put, here's what I'm going to suggest. Make sure you put the heading in. So it says your income statement is not complete?
Yeah.
Okay. Make sure you put the name of the company on top if they ask you to do it, okay? Make sure you have the necessary subtitles. Okay? And you know what I'll suggest? Is that something you could take a picture of and send it to me and I'll get back to you a little bit later?
Yeah, okay.
Okay, let's do that. You can text it to me or email it to me at home here or wherever you like. Yeah. Have you all run into that problem? You think you have a statement all done or something and it tells you it's not complete. It's usually for something real goofy like you might have put total operating income instead of total income or vice versa. So let me take a look at that, Callie, and I'll be able to get back to you shortly, okay?
Okay.
What do you think, Fiona? You hanging in there with us?
Yeah. I have a question. I always get confused between listing something as an expense or as a liability.
Okay. An expense is the actual activity that you incurred. The expense is electricity. The expense is salaries. The expense is insurance. It's the actual element of cost, right? And expense. If you're going to pay for that expense later, you have to set up a liability. The liability is just a way of financing something, really. Okay?
Okay.
You know, so in other words, if you had you bought supplies today at a store and you paid cash for it, there would be no reason to worry about a liability. But if you're going to pay for it later, the expense is the same. It's just a matter of financing it.
Okay.
Yeah.
Thank you.
Joanna, what do you think? You got something for us?
No, I think it's pretty clear right now.
Okay. Okay. Chapter 4 is going to be a little trickier when we get involved with adjusting journal entries. Chapter 5, we're hardly going to touch at all. It's just a little bit of an explanation about the SEC and a few things. So when's our first test? Does anybody know off the top of the head? It's got to be next week sometime, right? And it will be on the first 5 chapters. Mostly chapters 1 through 4, okay? Hey, does anybody ever hear of the Kinks from the 1960s? You never heard? Nobody ever heard of the Kinks?
Yes, I have.
Who said that?
Danny.
You know the song Lola?
Yep.
All right. You know how they tell me if this sounds like the intro. I've been working on this, and then we'll get out of here. Ready? You sure you know the song, right?
Yeah, of course.
What do you think?
Yeah.
Pretty good, huh? All right.
That's good stuff.
Now I got to get the last 5 minutes of it under my belt. Okay, last call for questions. Kalai, you've been sitting there in the darkness. Any questions?
I'm all good. I'm just listening.
I have
All
a
right.
question.
Okay, George, you're good. Question?
Yeah, I have a question.
Please.
When it comes to like the chapter 1 notes, Carolina, she went ahead and let me know that if I submitted a section that was missing from my notes, I would get full credit for it.
Absolutely.
Should I send it to her via email or should I resubmit it through the Canvas?
Either way, I think is going to be okay.
Okay, so I'll go ahead.
Yeah,
and
I
send it
mean,
to her email.
she'll see. I mean, she'll see it either way. You send her an email, she gets it maybe a little bit more quickly. So
Okay.
you can do that, but yeah, you'll
Okay,
catch up on that.
Thank
And
you.
by the way, I'm going to just talk real quickly here. Those chapter summaries are very helpful, believe me, because we think you do learn it pretty well when you're writing it down. Also, if you look at the syllabus, those are easy points to scoop up. You know, it would be so foolish not to do a good job on those summaries because those are points that are just waiting for you to be grabbed. Okay? I mean, I had one student, he thought he was a real hotshot a year ago, and I noticed he was doing terribly with those summaries. He wasn't handing them in or they were perfunctory. And he got A's on all the tests, but there's no way I could give the guy the A, which he probably deserved. So, and the last thing, has anybody talked to you yet about the FSAs? The financial statement analyses that you'll be doing shortly. Okay. I think I sent a note out. We're going to compare 2 of my favorite companies, Kellogg's and General Mills. And I can help you a great deal with those when the time comes. So my boss will have something out for you pretty quickly. Okay. All right. I guess we'll call it a day, huh? Do I hear another question? All right, we'll pack it in for today then, okay? Thank you for coming on board. And again, if you want a quick answer to something, texting me is probably the fastest way. Second fastest way is with my home email. And the slowest way is, the third slowest way is mail on the pipeline. And the fourth slowest way, if you put something in Canvas, because I do not look at that every day, okay? All right, we'll let you go. Give me the friendly wave.
Shoots.
Bye-bye, all. Thank you so much. You know where to find me.